There is an idea of Patrick Bateman, some kind of abstraction, but there is no real me, only an entity, something illusory. And though I can hide my cold gaze and you can shake my hand and feel flesh gripping yours, and maybe you can even sense our lifestyles are probably comparable, I simply am not there. Bret Easton Ellis.
I said there are three things that we're going through which are, I hate the word unprecedented, which are kind of unprecedented. And you got to put this in back of your mind. When you've seen things that have never happened before, then you have to question your ability to predict, okay? One is huge growth in this country driven by fiscal and monetary stimulation. That isn't a normal recovery, okay? And that fiscal stimulation is still in the pocketbooks of consumers. They're spending it. They're spending at very strong levels. And the data is completely distorted. It's distorted by inflation. It's distorted by they went from goods back to services. It's distorted by all these things, but jobs are plentiful, wages are going up, consumers are spending, the lower income folks, not quite as much as before, but everybody else, it looks like they have $2 trillion more, savings rate drop. I don't think that's going to stop their spending in 6 or 9 months. So that to me is the bright clouds out there.
We have a pump and dump economy since 2008. They pump, they dump, and in the process they fleece the middle class. Each time it takes more stimulus, lower interest rates, more QE, and each time it's less effective. Like a drug addict taking a drug. The first time it overwhelms the user, later on they build a tolerance to it. This is the same concept but with cheap, easy money. Businesses, banks, investments, the whole economy has accommodated this type of environment. Malinvestment, misallocation of resources. Cheap money causes distortions, and instead of a person's building something that society values, they're delivering McDonald's to us and groceries. This is why Dimon is saying this isn't a normal recovery. $2 trillion in savings means as prices go up, there are enough people that can afford those higher prices and bid the prices further higher. Instead of a supply and demand dynamic balancing itself out, people are able to purchase at higher prices. A price is a signal to the business supplying the good. If the prices are too high under normal circumstances, they can't sell the product, forcing them to lower the prices in order to sell. But if everyone can afford $10 lettuce, the price of lettuce will continue to go up until there are no more sales.
But it's different. The Fed has to meet this now with raising rates and QT. And the new part of this isn't the raising rates, it's the QT. The QT we've never had QE before like this. Therefore, we've never had QT like this. So you're looking at something they're going to be writing history books on for 50 years. What was QE? What worked? What didn't work? I think a lot of parts of QE backfired. I think the negative rates was probably a huge mistake for a whole bunch of different reasons I won't bore you with now. But they got to raise rates, and in my view, they have to do QT. They do not have a choice because there's so much liquidity in the system. They have to remove some of the liquidity to stop the speculation, to reduce home prices, stuff like that. And you've never been through QT. So all the major buyers, if you go back to 2010 and say, who are all the major buyers of treasuries? All that time, it was central banks, foreign exchange managers, banks who were topping up their liquidity profiles because we had to for regulations. All three, it won't happen the go round. Banks are topped up, foreign exchange managers are topped up, the central bank will be selling, not buying, and governments have much more fiscal deficit to finance. That's a huge change in the flow of funds around the world. I don't know what the effect of that is. I'm prepared for, I tell you, a minimum huge volatility.
So what was Dimon saying? Dimon was saying that QT is unprecedented. The only buyers that are around to buy bonds were the central banks, and foreign exchange providers, right? And he's saying that the banks and foreign exchange providers are topped up. That's why the repo market is at $2 trillion, is because they have all these high quality liquid assets that the government forces them to buy, right? So if inflation's at 10% interest, why would I want to hold a bond that's giving me 2.4% interest? There's no reason for it, except for if the government forces you to have those bonds as part of the capital requirement. So this is the 6-month yield, right? And this is what the the Fed has control over. The Fed has control over these short-term bonds, and that's how they peg interest rates to 0%. They just start buying bonds, and that forces this yield to come down, right? And this is illustrated here. This is when the Fed had QE and 0% interest rates. Here is 2008, and we had this long period of 0% interest rates. This is when they rose, and this is when they had to shut it off, right? So each time that they raise rates, it gets a little bit weaker. Every single time they're making lower highs this whole way down. And now all of a sudden, yields have spiked, which means that the bonds have sold. And you can see this is true for the 2-year as well. And this is another one the Fed has control over. But when we start looking at these long-term 10-year, 30-year yields, and the bond market selling off, the Fed can't buy these long-term bonds. Well, they can attempt it, but they have control over these short-term ones because they're short-term. Now, if they were to start purchasing 10-year bonds and 30-year bonds, those are bonds that don't leave the Fed's balance sheet for 30 years. So the debt will snowball if this spikes and goes parabolic. If this starts running, right, if we have the opposite of what happens, if this chart looks like this, the Fed is going to have to try to bring this down to zero. And at first, they're going to try pegging the short-term ones down to zero with hopes that this fizzles out. Because if this starts running and it doesn't fizzle out when they keep the short ones at 0%, what's going to end up happening is banks are no longer going to lend. You're not going to be able to buy a house unless you can have no risk, right? The banks are in charge of risk, so when they make you a loan, they're going to make sure that you're going to pay them back on the loan. So if this environment is really risky, the banks stop lending. And not to mention the interest rates spike to unaffordable levels, right? If you have to start paying 20-30% on your mortgage, then a lot of people are not going to be qualified to have a mortgage. And this is going to cause the housing market to correct. And we saw with 2008, that can't happen, right? So the Fed's painted into this box where they have 10% inflation and they can't buy bonds. But what I'm thinking is they're going to have to buy bonds at one point because the whole economy is going to have some type of Great Depression. So they'll be forced to purchase bonds to try to keep this rate down. So there's lending in the economy, so the real economy can actually, have credit creation where banks and businesses can get credit if they need it. Now, we're close to that moment, and we'll see what happens. But this is what happened. So since Bitcoin's inception, Bitcoin's pretty benefited from the Fed printing money. This was the last time the Fed raised interest rates, right? They did a small amount of raising interest rate, and Bitcoin fell drastically. This is when the Fed walked back. So there was 6 months where the junk bond market didn't have any bonds to lend, and it froze the credit markets back here. And this is why the Fed reverses policy. And you can see drastically Bitcoin runs and gets back into the range. This is C19. When C19 happened, we know the balance sheet expanded exponentially, and then we had this crazy run, right? So there's lags involved with all this. So just wanted to point that out. Now, the next thing is these interest rates. The government owes interest on all the debt that they have, right? And there's only so much they can tax, there's only so much revenue they can get without having to borrow to pay the interest. And this is going to snowball the debt. And this is what shakes confidence, is when you start having exponential growth in debt, right? That's when currencies really get devalued. That's when you see, some of these smaller countries start to get mass inflation or hyperinflation, is when the debt gets way out of control, and then it starts snowballing and starts, having an effect on itself.
That you've not had a European land war since 1945. Okay, and the complexity of Ukraine is we don't know the outcome. I always make a list, if you predict the outcome, well, you couldn't predict the outcome of Vietnam, Korea, Afghanistan, Iraq, 10 other conflagrations. All wrong. Wars go bad. They go south, they have unintended consequences, and this happens to be rolling the commodity markets of the world. Wheat, oil, gas, and stuff like that, which in my view will continue. We're not taking the proper actions to protect Europe from what's going to happen in oil in the short run, and we're not taking the proper actions to protect you all what's going to happen to oil in the next 5 years, which means it almost has to go up the price. We're not investing enough money, to keep oil a number. And for all those who love climate change, if oil prices go to 175 or 150, which I kind of think is in the cards, to tell you the truth, not in the immediate run, but down the road, then CO2 won't go up, down, which is everyone predicts because people buy less oil and gas. It's going to go up because all those other countries out there, the poor countries who need oil and gas to feed and heat their citizens, will not buy oil and gas, they'll buy coal. That's what's going to happen. CO2 will go up, it won't come down. And we're not dealing with these challenges. So those three things, fiscally induced growth, QT, Ukraine war. So I'm going to change the storm clouds out there because I'm an optimist. I said there's storm clouds, they're big storm clouds. It's a hurricane. Right now it's kind of sunny, things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy Sandy or Andrew or something like that. And you better brace yourself. So JP Morgan is bracing ourselves, and we're going to be very conservative in our balance sheet on, with all this capital uncertainty. We're going to have to take actions, and I kind of want to shed non-operating deposits again, which we can do in size, to protect ourselves so we can serve clients in bad times. And so that's the environment we're dealing with. And I think it's okay to hope that it'll end up okay. I hope it. That's my Goldilocks, I hope. Who the hell knows?
Usually these banksters like Dimon are cheering on the Fed and lying about everything. This is a rare take where Dimon is telling the truth. You could sense the fear that he has. Nobody knows what's going to happen. I think the Fed will print, and when they print, the dollar drops, inflation soars, and asset prices spike. But until they do, the markets are going to lose value. Scientists will test theories on lab rats. An economist does not have controlled experiments. They experiment on society. But this is what happens when you didn't want to visit and confront the past. The past starts visiting and confronting you. Bret Easton Ellis. Thanks everyone, I hope you enjoyed the show. Let me know what you think in the comments below. If you enjoy work like this and wish to support my channel, please consider joining my Patreon.